All right, welcome back to Bullish, everybody. I am Sam Hardy, joined as always by Nick Stenger. We are Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Kicking off Q3 earnings season here, we've got episode number 9. We're looking at PepsiCo, Delta Airlines, BlackRock, CitiGroup, JPMorgan, Wells Fargo, United Health. We got a couple other articles we'll talk about as well, but looking forward to it. Remember, everything that we talk about on the show here is not investment advice. Past performance isn't a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. Nick, how are we feeling? We're doing it on a Monday. It's a little gloomy. We got a nice view.
What's going on, Sam? You know what? It's a gloomy Monday, but you know what? It's okay. I had a very restful evening. I did go to bed at 8:00 last night, so I was up and at 'em this morning. I was up at the crack of dawn, 5 a.m. and organized some stuff in the kitchen for my wife. She says I was crashing around in the kitchen, so I guess it turned out to not be helpful after all, but that's okay. Here we are.
Yeah, I do the same thing. I wish I could say I went to bed at 8:00. I did not. And then today, as you know, our youngest figured out how to climb out of the crib. So we're in for a world of hurt tonight. I have a feeling.
Oh, yeah. So now, how old is your youngest again?
He turns 2 in December.
Okay.
And it just so happens that his older brother is his partner in crime, was helping him crawl out so he didn't fall and hurt himself, which, like, I guess is commendable, but I'd prefer that he didn't do it so that he wasn't crawling out. But
Well, I just want to point out, this is episode 9, right?
yes, episode 9.
Episode 6 did not get good reviews. We got 3 likes, and one person did not like it. They gave us a down like.
Which was that the Suits one?
That was the Suits one. I was kind of surprised. I thought that was a good episode, but I guess not. Feedback was not great.
I think most people probably don't agree that Suits are making a comeback. But as we do know, some in-office work is starting to make a comeback, which maybe Suits will follow at some point.
Well, you know what? Look, I might have been early on the call. I have been early on things before, but I will say one of my clients who happens to sell men's clothing, he sells casual, formal. I asked him, what's your top performing line? Is it the casual like it was during COVID still? He said, no, it's the opposite. Suits are his new bestseller. Back to Suits. So we might have been early, but I think we were right. And whoever downvoted us, you may want to rethink your choice there.
Yeah, and feel free to give me a call. My personal number's 630-912-8436, and we can discuss it in person, or just give me a call. I'm happy to hear your thoughts, and I can play mediator between you and them, Nick, so that things don't get too escalated. I'll be like the middle ground for you.
No, we're not going to get escalated. I genuinely am curious, though, what people's thoughts on that would be. And I do think return to work is coming back. You sent me an article today that talked about that, right? That people are, isn't there a CEO or something that is like giving bonuses to only the people that come back to the office?
Yeah, there's something about that. I can't CEOs giving employees bonuses and raises for coming back to the office. I can't remember who did. Somebody did a what is that thing called? Where they ask a bunch of people for their opinions on things.
A survey.
Yeah.
We're doing well today. We're doing well. We can't
all right.
think of regular words like survey.
Yeah, we can't
let's see how the show
words
goes.
today.
I'm guessing we're getting a dislike on this episode.
Yeah. Well, yeah, probably. We'll see about that. But yes, it was exactly that. It was a survey. It was like 90% of CEOs in the survey are more willing to give a promotion or something to people that they see in the office more. I didn't read past the headline, to be honest. So that's all the context that I can give. Um, but
Why am I not surprised?
I'm a
No, it's
big
all good.
read the cliff notes person. So all right, well let's get into it here. One article that I did read that I did think would just be interesting to kind of to cover really quickly is from FactSet, our friends over there. S&P is likely going to have year over year earnings growth for the first time since this quarter last year, and just something I think would be important to keep an eye on as we get into the bulk of earnings season. Right, we're basically in like week one of the craziness. Next week there's I can't even count how many earnings there are going to be. We're going to hit as many as we can, people. But I mean, it's a positive sign. Companies make a habit of under promising, over delivering. And if you look at the past 5 years, every quarter we've had earnings surprises. The mean earnings surprise is 8.5%. All right. And if we look at history, again, not a guarantee of future results, but likely we're going to have positive earnings surprises this quarter as well. So, we'll see what happens. 32 of the 500 companies have reported so far, and we're looking at 10.1% in surprises, earnings surprises through them. So if that continues with the other, 470, let's say, then obviously, things look good. And coming off of last quarter where both bonds and stocks were down, it could be a nice thing to see. So I don't know if you have any initial thoughts there, but if not, we can head into PepsiCo.
Yeah, I mean, I know we're covering banks today, but it's kind of like the common sense thing of the market, where the stuff that doesn't do as well typically ends up doing better. The stuff that's done well ends up moving to the bottom. It's just regular rebalancing. That's why we do our rebalance. And I'm always surprised by like people getting shocked by this. It's like, oh, utilities stink right now. If you own utilities at the start of the year, you're down 15%. The market's up 12 or 13 right now. And everybody, I'm not saying utilities are a screaming buy, so don't hear this the wrong way. But I would imagine at some point the tide turns for utilities and things get better, and then the narrative shifts. And then it's like you're going to look back in 2 or 3 years and be like, wow, utilities were a great buy. Same thing with financials. At the beginning of the year, we weren't overly heavy on banks. We were like 14, 15, 16% weight. So pretty much right in line with the market. But one of our biggest ones was JPMorgan, which I still tend to like. And we're covering them in a little bit. But that thing in March, it went from being 142, 143 a share down to 125. I had clients saying, like, Nick, the world's coming to an end. JP Morgan's down, whatever that is, 13%. Like, what do you think? Like, you were saying JP Morgan's a great company. And I'm like, I still do think it's a good company. And then fast forward and like you buy more and like, what do you and I always talk about in the office and the rest of our group? We always say it's the bear markets where you make your money. And it's like right when you think, oh, things could not be worse, that's the exact time when you should be adding to the stock. So it's like if you bought it for 143, it's up to 148 right now. But if you were adding to it in that 125, like, that 130 zone, whenever you could get into it and add more, it was a great buy. And then those trades, were up 16, 17% in 6 months, 7 months. That's a fantastic way to invest. But it's just that human psychology thing. When you go through these corrections, that narrative shifts and everybody gets so nervous and nobody wants to buy. And that's like almost the exact time when you should be looking at adding. That we just went through that with InMode not too long ago. And again, not stock advice for this show or anything like that. But, it's like, man, that thing got whacked in the short term. But every time it gets whacked, it's past performance, no guarantee, but it comes back, and it's that Peter Lynch quote I sent you over the weekend. He goes, I bought stocks for 15 and they've gone to 2, but then they went back up to 30 at some point. That's the investing methodology. So when you go through these earnings cycles, it is cycles, right? Sometimes certain sectors do well. Sometimes certain industries do well. We saw that with energy the past couple of years with inflation kicking up. Energy was this great trade. Do you want to come in and overload on energy here? No, we've got an allocation to it, but you just have to be smart. Most people, they chase that performance, they chase return, and they get in at the top. And then when things go down and turn south, then they have to like panic and they don't want anything to do with these stocks that they thought were great at all-time peaks. So if you can do the opposite of that, you'll become a pretty good investor.
Well, it's, you say it a lot is you want to find good companies, but you got to also buy them at good times. If you buy a good company at the wrong time, you can definitely hinder what your long-term, possibilities are there. And I know your show, I think it was 130. So a couple ago was Bye Bye Baby, kind of going through that right when we were towards the bottom of, that September correction that we had. So if you haven't listened to some, Nick's show by himself, the Nick Stenger show, which is on, YouTube and Spotify and Apple, make sure you go in and give that a listen as well, just because it's a really good kind of more broad market analysis of everything and how we look at stuff. So,
Well,
um,
one comment I'll make on something you just said is buying stuff for the right price. Look at ARK. Remember the whole ARK craze during 2020 and 2021, and that thing peaked. The ETF peaked at 156 roughly, a little over 156. Guess what it's at today? Don't look at it. What would you guess it's at? If
I
you
already
already looked
pulled
at
it up.
it. Oh, too late.
I'm too quick with it, but I mean, yeah, it's down 75%.
Oh yeah, yeah. And I had people saying like, "Oh, now's the time to get in. Kathy Wood is a genius," which she is. She's a smart person.
Hmm.
But man, some of that stuff just got run up so tremendously that she may be right in the long run, but to me that was the tech bubble, and everybody kept calling for a tech bubble. Remember, everybody's like, "Oh, we're gonna have a tech bubble." It's like maybe, but you have to define what tech is. It's like there's certain parts of tech, ARC, some some of the ones where like PE ratios are 200 or 400 or 500. Yeah, there's a bubble there, and it burst. No question about it. But then
Yeah.
the rest of tech, like you have to sort of like think, okay, big tech is not really even big tech. It's some of these things are almost like utilities. It's like Google. Like how long do you think you could survive without Google? Not too long. Like I don't know if you've ever tried to use Bing, but it's a disaster. So you have to think through like really what are these companies worth? If you go out and pay 100 times for Google's earnings, you'll probably pay the price for that at some point. Now it's trading for about 30 times earnings, which it's probably rich, but it's not 100, it's not 200, and it's actually a real company with real earnings and a real balance sheet and lots of cash. By the way, all that cash is earning 5.5% risk free right now. So, I
Yeah.
just think people don't really think through how the market works. They just say, oh, it's the market and I'm going to buy no matter what, and they don't really give any thought to what they're buying. And that's what we do on this show. We try and tell you what you're buying.
Yeah. All right. Well, let's get into PepsiCo here. They were in line with their estimates. Revenue increased 6.5%. Earnings per share for them up 15. If you look at the stock, it finished the week down about 1.25, and we're looking at it being down about 11% year to date. Price return there. So they had strong results from snack and beverage. Think it's Pepsi products, Gatorade, Frito-Lay, Quaker on the snack side of things. And if we take a look at headwinds they've faced, continued battling price increases due to some of the inflation, obviously a drop off in volume to some extent, but not as much as they thought. I think it was like 2.5% I saw. So analysts seem to think, like, if you look at the competitors, they say they're all undervalued at this point. And I know you're going to have an opinion on that, but the last thing I'll say for Pepsi is this: it's a very well-known brand. They are diversified in what their customers want. They have a number of different large brands underneath them, and they are going to continue their battle with Coke as they expand globally as well. So I'll let you take it away.
Yeah, great company. I mean, iconic brands. Didn't we talk about Cheetos? Oh yeah, Cheetos was we thought it was last week. It's actually this week. I love the Cheetos. Zach, sorry, but I ate half the bag of your Cheetos and I am now paying the price. I have to go to the gym. So now in hindsight, I wish I wouldn't eaten your Cheetos, but I do apologize. Zach's our intern. Um, who is the snack king? I think we
Yeah.
can all agree. And did you know they make Sabra hummus?
I did not know that, but it is delicious. And I also have to admit to eating some peanut M&Ms from Zach as well. So if we're coming clean on snacks that Zach got that we ate, Zach, I owe you a bag, buddy. And congrats, they just got engaged.
Oh yeah, congrats.
So
Zachary and Avery are two wonderful interns who are dating and are now engaged. Congrats. That's awesome. Okay. So going back to Pepsi, that was got a little sidetracked there.
That's all right.
They have done a nice job, I will say, diversifying into healthier options, which I don't know if they're really healthier. My wife could tell you. She reads all the labels. She goes into depth on this stuff. I'm sure she'll roast me when I get home about this, but I'm pretty sure some of the stuff they have is better for you. I think like easy example here, smart food. It sounds smart. It sounds healthy. I don't know if it is.
Well, that's that popcorn. It's like the 60 calorie bags of popcorn or something like that. I go full salt, full butter on mine, but if that's the kind of thing that you're into, that it's good.
Okay. Yeah. So there you go. Look, it's a great company. I have nothing against it. I've always just been a little cautious on the price. I've always just said, all right, if you pay the right price, it's a good stock. I got a little nervous in the COVID era and then coming out of I guess not even the COVID era, but really just earlier this year when consumer products and I guess some of this is even consumer staples, it just got so overvalued. And you saw this with the PE ratio. The thing was trading for 30, 35 times earnings. Right now, it's coming back to earth a little bit. I still do think there is some downside here ahead, but it's not a bad company. If you're looking for some yield, you're getting a 3% dividend. The all-time high was 196. So I think if you got a 3 to 5 year time horizon, just like any stock, it's going to be fine. But I don't think it's the cheapest that it could ever get to. I think in a real bear market or in a like let's say the market drops off, this thing could correct to being worth 20 times earnings. Right now it's 25, so it's not like it's going to completely get killed. But you could see it go down 20%, and then I'd be super interested. I just think from a valuation standpoint, you got to be a little careful on these things before you load up.
Okay, let's do Delta Airlines. I know you're a big fan of airlines in general. They beat estimates across the board. Revenue actually was up 10%. Their earnings per share, they clobbered. It was up 60%. The stock has taken a little bit of a beating since earnings came out. But as far as airline stocks go, like if you look at all the other big ones, they've had a pretty good year, and people seem to be encouraged by these results. Obviously, fuel prices going up in the summer ate into that profit, but it's not like they're dumb. They're forward looking in what they think oil is going to be, so they increase ticket prices accordingly. The thing to keep an eye on in regards to that, though, is we have had all this pent up demand for travel. People have to get out. They have to go do things that they wanted to do the last 2, 3 years. And how long until that runs out and the high prices are, they just lose interest. They lose their client base. People aren't willing to pay a premium to travel anymore. And they think, I can wait a little bit.
Yeah. Okay. First of all, how you already mentioned it. You know how much I love airline stocks. For those of you
The
watching that
best.
don't know this is a joke, I am kidding. I do not like them. But if you got to own one, for whatever reason you think I should have an airline in my portfolio, well, first of all, think twice about that. But then if you still decide you'd like to do that, Delta is the top name. I mean, it's definitely the highest quality. It's down half as much as the other one, so I guess that's a win. But yeah, I mean, like airline stocks are the place where capital just goes to die. It's just an absolute disaster. So I don't know. It hovers between 7 and 10 times earnings. The only reason the 5 year is 16 on average on a go forward is because of 2020 when it traded like a tech stock for 158 times earnings. So you can't really put that in there. If you look at all the years prior, in 2019, it traded for 7.8 times forward, 7.4 in 18, 10, 10, 8, 10, 9. So it's right in line with where it should be. Maybe you get a little multiple expansion, but it's not dirt cheap by any means. And I think this is where people have to really be careful with just doing simple analysis on stocks and really go the distance to make sure you know what it's worth. Because you could look at this thing right now and say, oh, it's got a current PE of 6.5. It's got a forward of 7.5 or 8. It looks cheap. Yeah, but is it cheap to the market or is it cheap to itself? It's like, not really. It's got a lower PE than the S&P 500. Doesn't necessarily make it a good company. So cheap in investing does not necessarily equal a good stock, right? You have to really be able to determine the difference there.
Okay. Yeah, let's cover our favorite BlackRock. They met top line estimates, beat the bottom line by some margin. Revenue was up 5%, earnings per share up 15. Stocks down about 1.5%. It continues a tough year for them. And I mean, there's plenty of things you can say about them. I know we had talked last week about that article from Advisor Hub, so I figure we could just kind of talk through that some. But the big thing with them, they had AUM fall 3.2% last quarter, 9.4 to 9.1 trillion, which if you just think about they have over $9 trillion in assets under management is absurd to think about the size and scale that they have. But they had clients pull 13 billion from long-term funds last quarter, and it was it was the first time they had outflows since 2020 during the pandemic there. And so I know some investors are holding cash on the sidelines and taking advantage of money markets at this time, short-term treasuries. And so that could be part of it. I know they had some trouble with one of their institutional clients abroad. I think they pulled like 19 billion alone. But I mean, they're the largest asset manager in the world, and they're having, net outflows for the quarter. So, I don't know if you have any thoughts further.
Yeah, I mean, look, BlackRock, I'll give you the bull and the bear case, and then we can go from there. Here's the bull case. They're in literally every pension fund, every 401k. They're everywhere. They're, like you said, a behemoth. They're the biggest they're just massive, right? Now, most of that growth came after the GFC, after the great financial crisis. And I think they got Wells Fargo's asset management business. They got all this other business basically handed to them. So BlackRock was nothing. And in fact, they were kind of like the laughing stock on Wall Street for the longest time, just until recently. The GFC completely changed the game, and now they're this massive asset manager. So the bull case is like the big get bigger. They're just going to keep getting more flows. How many billions of dollars exist in these 401k plans? And then just naturally hundreds of millions of Americans that are adding to these things every year, just naturally, so they get the flows. That's the bull case, which I can totally see. I could buy that. And I actually really don't have a position on this other than a kind of a personal values position. So we'll talk about that in a second. But from a pure investment, I totally understand the bull case here. It's hard to stop. They're the 800-pound gorilla. Here's the bear case, and I really do see this on a frontline, from a frontline viewpoint here. And you saw it with Strive. Strive's one of the companies that we've talked about in the past, the ETFs that vote the proxies pro-America, pro-excellence, and it's not necessarily political voting. It's not Republican or Democrat. In fact, they were funded by a Republican and a Democrat. So it's not like they take a political stance. They just take a pro-excellence stance. I do think that is catching on. And you've seen it with Strive's flows. They're up to $1 billion in assets now. Now, are they going to eat BlackRock's lunch long run? Realistically, probably not. They will cut into some of it, and then BlackRock will be forced to pivot. But I think the damage is already done. I think that a lot of people in our space, like advisors, really are unhappy with the way BlackRock has gone, and they are going to vote with their dollars, and they're going to move. They're going to move to Dimensional. They're going to move to maybe Strive, some of these other places, First Trust, where they don't have to worry about these proxy voting policies that are anti-American. So that is the bear case. And beyond that, from a financial standpoint, BlackRock is basically priced for perfection. They have to perform. They have to bring in, another $1 trillion to basically stay where they're at. If they don't, then it really becomes tough to support the stock price. They're trading for 20 times forward earnings, and the closest asset manager is going to trade for 10, and that's with 5% growth. Now, obviously, these guys have grown and taken a lot of flow from other places, but a lot of that initial business that they won from the S&P 500 space is I think not done. They're still going to get flow, but it's just not going to be the same as it was. If you go back, so their trailing 12-month revenue now is about 17 billion. If you go back to 2013, so 10 years ago, it was 10. So they've almost doubled within 10 years, which is pretty good growth. But now the growth is really starting to slow down. And you saw this, 2021 was record revenue and record profit, and now that's coming back a little bit. So I just think from an investment standpoint, it is going to come down to their price for perfection. And I think a lot of people are upset. By the way, if a team like us, where we have hundreds of millions of dollars under management, there's teams much bigger that have a billion or 2 or 3 billion. If they decide they're going to vote with their dollars and take the assets away, those are big hits. I mean, you could lose 3, 4, $500 million overnight. Same thing with the states, and that's a huge piece of this too. You could see red states actually move money away from BlackRock, which they're doing, and it's a political driven thing too. So that's where I'd have some concern. But I could see the bull and bear case from a value standpoint. I said I'd mention this. I don't agree with what they're doing at all. I think they're completely selling out the American people. And again, it's not a Republican or Democrat thing at all. So please don't hear this the wrong way. It's just a standpoint of they are voting proxies actively against American interest under the guise of ESG, environmental social governance, which to me, and if you actually do the digging, is communism cloaked in fancy marketing. That's all it is. These ESG scores are completely arbitrary. And for the SEC's credit, the SEC has been pretty aggressive here under Gary Gensler, which is, so got some positives, some negatives. He's gone after some things he probably shouldn't have. But one of the things I actually would applaud him on is going after these ESG scores that these asset manager companies and even Morningstar have put and said, like, listen, you can't just like have ESG be the only thing. It actually has to outperform. It has to be good for investors. Why? Because you have a fiduciary responsibility when you're managing money for people to deliver performance, right? For the lowest cost possible. And if you can't do that, and ESG is your only way to grow your business or to get assets in the door, that's not good enough. Like it can't just be ESG. So I think the SEC is actually rightfully so cracked down on this. And so BlackRock, you saw another article saying BlackRock has had to actually close down a number of its ESG related funds, like some of these other asset managers. And that's great. I think ESG is one of the biggest atrocities that we've experienced over the past 10 years now, where it's taken what should be shareholder capitalism, it's changed that to stakeholder capitalism, which is just it sounds like a small difference, but it's not. It's a massive difference in mentality of maximizing profits and producing earnings for investors. It's gone from that, which it should be, to a different agenda, which is, we're going to do carbon emissions. We're going to do all these different proposals. And in the end, it's bad for investors. It's bad for employees. It's bad for shareholders, of course. It's bad for management. It's just bad for the country. And so you're going to see this continued backlash, in my opinion, against ESG. I think the cat is out of the bag, and it's going to be hard to really reverse on this. So that's where I don't own BlackRock. I'm not going to go buy it. I still don't even think it's cheap, even if I was going to go buy it. So for investors, I'd stay away. But who knows? Maybe it'll perform down the road. We'll see.
Well, and they had there was that article, I think it was about a month ago, talking about how they had invested in companies that were directly tied to the CCP and their military interests. And there was a U.S. House Open Committee, looking into that and requesting more information and everything on that front, which again, is a threat to, us. So another thing to keep in the front of mind there. And, obviously BlackRock's huge, so everybody's going to try and find an issue with them, but there's definitely some fundamental things. Like you said, I will agree with you on that front. So we'll move on to, we got a few banks here. Let's do CitiGroup. They beat bottom and top line estimates. Revenue increased 9% year over year. Stocks down about 2%, and they've had a tough year, but look at the 5-year as well. It's been pretty brutal. The positives for them this last quarter, they saw growth in their institutional clients group, personal banking and wealth management segment, which, Citi's card business is a big piece of that. It makes up like 50% of personal banking revenues if you look at it. So the biggest thing, and this is true of Citi and the other two, JPMorgan and Wells, which we'll get to, is the increase in net interest income has been the biggest overall driver of growth for them, and what's going to happen there long term. So, I don't know if maybe you want to touch on too as well, just kind of how net interest works there. But something that we'll definitely talk about across the next three companies.
Yeah. I mean, I think we were talking about this today. It's like, I was listening to the Charles Schwab business update from the quarter, and,
Hmm.
they're like, hey, like, surprise, surprise, higher rates are good for us. Like, higher rates for longer are good for banks. Shocker. Like,
Yeah.
should that really surprise anybody? And I think like that panic back in March, rightfully so, scared some people. If you were in a low quality bank that didn't manage duration risk, I get it. It was bad. Obviously there was some bad management there. But I continue to believe that a lot of those defaults on those banks like SVB or First Republic, I really thought that was management driven. And so far that's been true. It's not to say Citi couldn't have trouble. I think any of these banks, given the right circumstance, could have issues. There's no question about it. But I think they're much more insulated than a regional would be. And it really shouldn't surprise anyone that their net interest is up. Now, the question is going to be, remember, investors want the future, not the past. So it's really going to become a question of, is that net interest durable? Is it durable to the level it's at? That's probably where investors are correct on this thing. And Citi, look, I bought it back in 2020. We've kind of held it through the cycle. So we've clipped that it's like a 4 to 5% dividend, but you just don't have a whole lot of revenue growth. So, in hindsight, I wish I would have sold it, a little sooner. But I think at these prices, look, it's definitely a value. It 100% is a value. Again, none of this is investment recommendations, so don't go out and like overload on this. But if you look at it, it's pretty dirt cheap. I mean, it's not the cheapest it's ever been, but it's pretty close. And we always look at price to book on something like this. It's trading for basically 42% of its book value. Which, when you see a bank that's trading for 42% of book value, it's not I guess I shouldn't say screaming buy, but if you ask anybody in financial analysis 101, they'll tell you it's pretty cheap. So it's either cheap for a reason or it's going to keep getting cheaper. I will say, I think it's sort of like catching a falling knife on this one. So you could see some more downside. There's absolutely no revenue growth. It's like, it's producing the same amount of revenue that it did in 10 years ago. So it's not like it's this growth story, but the way that banks become better investments over time is they do financial engineering. So one of the things they do is they buy back stock. That's a good thing for shareholders. It's now doing $6.35 on a trailing 12-month basis in earnings, and 10 years ago it was $4.35. So that's how they become a better investment, and then they keep paying more and more out as in dividends. So for a dividend, thing pays 5.18%, and it's down roughly 48% from its peak in 2021. So, if you're looking for a little part of your dividend portfolio, I don't think it's bad, but just be aware of what you're getting into. It's not, this isn't like the best of the best all time, greatest investment you're ever going to make. It's going to be sort of like catching a falling knife.
Okay. All right. Well, let's move on to maybe an opposite story on the banking side of things with JPMorgan Chase. I was reading the Morningstar strategist that covers them. I got to quote the guy here. He said, if banking's supposed to be under more pressure these days, somebody forgot to tell JPMorgan. So, I mean, they've just been killing it. They had a great quarter. They beat top line revenue, a really nice surprise in the bottom line earnings. Year over year increase for them. Revenue is up 22%, earnings per share up 39. So, stock's up here, continues to be a top performing bank, and, net interest for them is something they've really capitalized on. It's up 30%, and that includes some of the assets they'd acquired from when First Republic went under. I think it was like 21% if you exclude some of those assets. But I mean, most people would argue, if you read what analysts are saying, JP Morgan's pretty fairly valued at the moment. But if you wanted exposure to financials, they're basically the lowest risk option you can get as far as banks go.
Yeah, and I think, Sam, how many times do we talk about stocks are a claim on real assets? You're not just buying a ticker, you're buying a real company. And that's so important for people to realize that this is truly, I mean, that truly shows itself with financials, right? And shows itself with energy and all these different things. But the reality with JP Morgan is it really is dependent on the CEO. And a lot of bank stocks, not every company out there, but like bank stocks in particular, for whatever reason, are very dependent on the top of the top management. And I don't know if that's the way like risk management is run or something. Maybe there's like a general Like Jamie Dimon is a sort of a doom and gloomer, so he prepares for a rainy day better than others. I think that's been certainly true here, but the quality of bank management really moves the needle. Like more than any other company, in my opinion. So compare JP here the past 5 years, up 37%, not including the dividend price return, versus Citi is down 40%. Bank of America is no different. Bank of America is down 5%. So, Wells Fargo, for example, down 21%. So it almost really becomes a story of management. And that's what we've keyed in on. JPMorgan's been one of our top holdings for a number of years. It's like a top 3 or 4 holding for us because of that. And we don't own tons of bank stocks. We own a concentrated 3 or 4 names because of this. And if you're, like you said, if you're looking for the flight to quality, this is it. I mean, these guys are like I don't think people realize they produced in the third quarter an 18% return on equity. That's absolutely insane. Like Morgan Stanley is not even getting close to that. Most of these banks aren't even getting close to that. And it just puts JP in a league of its own. Anytime something bad happens, somebody goes out of business, they pretty much get first stab at buying them. And earnings were $4.33, which are probably not completely durable. But even if they go down, in half, let's just say doomsday scenario, earnings get cut in half. I still think this thing is worth, whatever it's trading at today, 140, 150. Like it's still a great stock. So, I don't know. It's just one of those realities of dealing with the big Fed. The bigger and bigger the Fed gets, that they're the ultimate bank, the bigger these top banks get. And if you're going to buy a bank, this is the one to own.
Okay. All right. Well, I know I joked with you before. It's kind of like the rose between two thorns for today's banks. So we'll jump over to Wells Fargo, which honestly, this quarter was less of a thorn, but if you look back over time. So, I mean, they beat on both the top and bottom line. Increase in revenue, 6.5%. Earnings per share was up 70. Market reacted well with the stock up 4.5%. Which it is flat on the year now. So it basically got them back to flat. But as it continues to progress through the restructuring here, it will be something to keep an eye on with their management of their expenses, especially as they look at, they're still under that asset cap. I think it's $2 trillion through at least 2024 until they get their house on order. That's what the Fed threw on them, right? So they same story. Net interest income's a big driver. They were at like 8% year over year increase, so much less than JPMorgan per se. But yeah, you can. I'll leave it there and let you share what your thoughts are.
Yeah, it's just Wells Fargo is just a dumpster fire, right? It's like just bad management, not knowing how strategy works, not knowing what people are there for, not realizing what the shareholders want. Like it's just a complete dumpster fire. Like for you to go out and buy this thing right now, literally a miracle would have to happen for it to be a good investment. But the diluted earnings per share are literally like 15 cents higher than they were 10 years ago. It's a mess. It's a complete mess. And you know what? I would be willing to bet in 5 years, EPS is about the same as it is now. It's not going to be a whole lot better. Maybe it's slightly better, but I don't think investors are going to value it like it's a growth stock. I think that we could all agree on. So you're buying it for the dividend, and good luck if you're going to buy it. I wish you well.
All right. Well, all right. Let's jump to the last one. We got United Health Group, top and bottom line beats as well. Really strong quarter for them. Revenue was up 14%. Earnings per share was up 12.5. We've seen the stock jump 2.5%. So clearly the market liked what they had to say. They're playing to their strengths. They're basically the largest healthcare company in the U.S. And the one thing that's going to be interesting to watch for them over the next quarters, we've got the open enrollment for Medicare coming up. They have the 4-star overall rating from Centers of Medicare, Medicaid, all that kind of stuff. So, typically 4 and above is what most people are looking for. I think like 3/4 of people. So they've set them up. They've set themselves up, for success moving forward. And, again, a behemoth in the space. So
Yeah, this is a fantastic company. We've owned it for a very long time. It's one of our top holdings. The stock is up exactly how much it should be up. The earnings have gone up with the stock price, so it's done very well. These guys are managed very well. They know how to survive in a lot of different environments, and they deserve to be where they're at. Quite frankly, I mean the PE to me is not like it's not radically overvalued. It's rich. I mean it's not terrible. It's not the cheapest it's been in 10 years, but it's not far off. I mean, the 5 year average on the PE was 19 and to go forward. It's actually at 1905 right now, so it's like right there. It's not bad. Certainly the regulatory environment caps it. That's your only risk is if something radically changes here. From a regulatory standpoint, then yeah, United Healthcare has problems, but I don't think they're going to be able to get that passed. It survived Obamacare, and I think the other thing here is it's high quality. Okay, and this is what I keep going back to. If you buy the biggest names, the highest quality in each space, management teams matter, strategy matters, quality matters. And if you compare this to other peers, you compare this to Cigna. Cigna has done half of the return of United Health Group over the past 5 years. And so that's the reality. It's like whatever you're buying, it really does make a difference. Look at Elevance, it's up 65% the past 5 years. The bigger get bigger, the top keep going up, and the people at the bottom don't do as well. So I'm not saying Cigna is a bad company. I'm saying Elevance is a bad company, which is the old Anthem. I'm just saying if you're going to own a name in this space, own the best one. To me, it's United Healthcare. It pays a small dividend. $500 billion stock. Your biggest risk is regulation. So I would be watching that. Somebody's going to displace, somebody will shake up the insurance game at some point. But for now, I think it should be a significant part of your portfolio. It shouldn't be 10% or anything like that, but I think we're 3 or 4%, somewhere in there.
Yeah. All right. Well, thanks, Nick. Obviously, we'll have another slew of companies to talk about next week. Remember, if you like the show, subscribe, share it with others who you think might enjoy here. If you like to learn more about Stenger Family Office, visit the website, call us at 630-912-8431. Request a complimentary starter kit. You can start a relationship with us for just $1,000. And then obviously, we've got our 2024 Investor Day coming up November 14th and 15th at Hotel Indigo in Naperville. So if you'd like to join us there, we would love to see you. We appreciate you listening, and we hope you have a great week.